Today is the August 19 Paris chapter presentation. Our host today is Andrew Cox, who is the Senior Retail and Market Analyst for FreightWaves. And he will do a presentation of his company's software where it indicates the transportations and logistics of where we are today. So welcome. Thank you for joining us. And please go ahead and the presentation. Thank you.
Thank you, Vivian. Thanks for having me for the FANG group. So I'm going to present more or less a look at the US domestic transportation market, but I do have the feeling that many of the same things that are affecting the US market are also affecting the French market or many of the European markets as well. So I think a lot of it will be related. Let me share my screen with you all. So, can you guys see that okay?
Yes.
Okay.
Yes, perfect. Mm-hmm.
And just a little background, I guess I can give on FreightWaves momentarily. So FreightWaves, if you're familiar with Bloomberg up in New York, the data and media company, FreightWaves is very similar, but focused solely on freight and logistics. So we have this data platform, which is where most of the charts that I'm going to show you today come from, called Sonar. It is a very robust data platform that helps transportation providers as well as retailers and manufacturers get a better understanding of the logistics network and whether they're overpaying or underpaying, such as that. But it's also very useful for financial institutions. There's many use cases, but that is Sonar. And then on top of that, you have the media arm. That is where I work. I'm in the research and media. So I have a couple podcasts every week, and I write a newsletter twice weekly on retail supply chain trends. And so basically, I try to evangelize the data from Sonar, like I'm doing today, just making the data more applicable and understandable. So last time I did a FANG meeting was the 24th of May. And some of the big trends that I spoke about then were this exorbitant freight demand that was just seemingly unabating. Transportation capacity was at historical tightness. And there was significant transportation cost inflation on pretty much everywhere you looked, on ocean, on air, on trucks, on the rail. And as we sit here today in the middle of August, demand is even higher. Capacity is, if it's any looser, it is marginally looser. It is still every bit as tight. And that is the case for sea, air, and ground. And rates are much higher on sea, air, and ground as they were in May. So, okay. As long as you can see that, okay. So this is our outbound tender volume index. So this is one of kind of the breadwinning indices that we have within Sonar that we create ourselves. And it is a measure of domestic truckload demand. So this is an index that is indexed to 10,000 beginning on March 18th. That is the beginning index value of 10,000. Currently, as we sit, we're at 15,824. The blue line that you see is 2021. The green line, 2020, and the two lines below that are 2019 and 2018. So for some perspective, those 2019, 2018, those would be considered normal years. The green line, as you can see, that is 2020. The initial bump here in late March, early April 2020, that was this just surge in demand that we saw when the country was immediately locked down. So consumer demand exploded. People started stockpiling we didn't know what was coming, but we knew that the country was going into lockdown and people needed groceries, people needed CPG, and they'd stockpiled. This was this 30% demand jump in March of last year. But as quickly as it came, it dissipated. So at this point, none of the country was really open except for what we considered essential stores. So Walmart, Target, the grocery stores, those types. But many of the other retailers were not open. So freight demand plummeted. But when the economy kind of began to reopen, stores began to figure out how they could operate with limited capacity. Freight demand exploded. So what happened in the US last year, I assume similar things happened in Europe. Services demand was not available. We couldn't spend money traveling. We couldn't spend money at restaurants or at bars and stuff like that. So we diverted a lot of our spending towards goods. And in the US, we had a lot of fiscal stimulus. So consumers were in a really good space to spend. We still are to this day, but this is the big rush that you see last year. So freight demand really just this straight rush to where we are today at about 15,800. So the freight demand has been persistently really strong since about Labor Day, since about September of last year. And it's just stayed there all year. Freight demand is very, very strong. And the freight demand is driven by a steady flood of imports. So this is our inbound ocean TEU volume index. So it gives us an idea of how many TEUs are coming into the US in all of our ports. So this beginning in 2020, you can see part of that initial rush on consumers, imports flooded before ports were closed down and a lot of the capacity was taken offline, plummeted, much like our volume index, but surged back quickly into a peak last year. So this is our peak of last year in import volumes in September, a traditional peak season. We already surpassed that earlier this year in Q2. And we've been kind of on a downtrend for the last several months as COVID has kind of ravaged China. We've had a lot of port congestion in the US, but things are reversing. We've got more congestion at ports right now than we had even earlier this year. We're going to break all of our records for congestion. There's a steady flood of imports, and it wouldn't surprise me if import volumes come the end of September, are back above the previous highs that we had earlier in the year. So, as I said, was talking about capacity. Capacity still remains very, very tight for trucking in the US. But it's not that tractors aren't being added. Carriers are trying to grow. They're trying to expand and take advantage of this strong demand. There's been 45,000 tractors added this year alone in the US. But it's not making a huge difference, truly. So this is our outbound tender reject index. So this is a part of that volume index that I showed you earlier. So that volume index is all of the total tenders, electronically tendered loads from shippers to carriers or from shippers to brokers for them to try to get loads covered. Now, those loads are either accepted or rejected. The higher the rejected rate, the tighter capacity is. So when carriers are rejecting a lot of freight, it means that they have options. They're willing to go test the spot market. They're willing to go test another shipper and try to get higher rates. So they're rejecting more freight. So thinking back to when I was speaking about 2018 and 2019 kind of being normal years for freight. So 2019 is here in orange. What we would expect to be a normal rejection rate between 5 and maybe 8 or 10%. When we get up towards that 8 or 10%, that's when we're thinking that capacity is getting pretty tight. Rates are going to move higher. And so for all of 2019, we were between that range of really 5 to 10%. Come 2020, we started out there. Capacity was relatively loose to begin the year. And then that rush on consumer goods, carriers quickly started rejecting freight because they understood the time implications. They understood that they could get more out of their shippers. So they started rejecting more freight. But again, as soon as demand fell, as did the rejection rate, but it followed a very similar trend to the volumes. Again, surged in the back half of the year. So in the early days of the pandemic, there was a lot of capacity that was taken offline. Drivers left the market because they weren't getting any good rates or weren't getting volumes. Many carriers furloughed workers or tried to wind down their balance sheet. So there was about 3 or 4% of capacity taking offline in the early days of the pandemic. And that's a significant number in the US. It's a very, very tight and very fragmented market. Just small changes in capacity can have lasting impacts. But so, like I said, that big run up to about 25%, meaning 1 in 4 electronically tendered loads in the US is being rejected by carriers. That is a lot. Imagine you're a shipper and 1 in 4 of the loads you're trying to get covered are being rejected. It's been that way since September of last year. We were very high throughout the entire back half of last year. We began this year actually downtrending a little bit. Volumes were a little bit slower to start January and February. That's a typical seasonal period for slow volumes, the early months of the year. But we had this huge power outage in the U.S. back in February. We had some winter storms that hit Texas and hit a lot of the southern states, and it was really, really bad. It cut off many of the major highways. It left 10 million people without power for, I think, 2 weeks. And that just surged volumes after that. We had a lot of just things that sat in the warehouses, sat in factories awaiting to be picked up. And that surged volumes, and it also made carriers start rejecting a lot more freight. So we've been kind of downtrending since this peak that we had post winter storm in March. As you can see, it's a pretty steady downtrend, but we've kind of found a bottom here. And I believe we're getting into the early days of the peak season, and all of the progress that we've made over the past several months is about to go by the wayside, and rejections are going to begin rising pretty rapidly here going into peak season. So carrier capacity remains really, really tight, which is driving trucking rates to the highest level they've ever been. So here we're looking at two different sets of data here. We're looking at spot rates and contract rates. So, and the big difference between these two rates is the inclusion or exclusion of fuel surcharges. So in orange here, which is on the left-hand side of our y-axis, is in orange. That's our van contract rates. That's produced by us at FreightWaves. And then this blue is the spot rate produced by truckstop.com. It's also for dry vans, but you can see just this surge since the bottom in April of last year. Rates are up, from $1.75 then, now at $3.38 per mile. Spot rates are extremely, extremely high. And ocean rates have either never been higher. This is probably the most startling chart of the day. This is our Freightos Baltic daily index. So we're getting price per TEU from China to the North American West Coast in blue, and China to the North American East Coast in green. So to the East Coast takes a little longer. It's a little bit more service. It's typically a higher cost than to the West Coast, but both have surged in 2021. So since the summer, it has been every 2 weeks, general rate increase of about 4 or 5% every 2 weeks, like clockwork. And we did hit a peak in early July, but I am very confident that we're going to retest those peaks in the coming weeks. And there's things driving up prices now, like the port of Ningbo. I'm sure you guys have heard that they had to close one of their terminals. It's the third largest container port in the world. They had to close one of their terminals down after one dock worker tested positive with COVID. They shut it down for 2 weeks. They are supposedly getting into the reopening phase and expect it to be back online by the end of next week, but there's still probably a week or two's worth of freight that's piled up that they need to work through there. So it's just this ripple effect that goes out throughout the entire world. It creates congestion at the ports where they were supposed to arrive. So we're still going to be dealing with the effects of that slowdown for weeks to come. And the problem here, the threat here, is that China has been very, very stringent on their COVID restrictions. If only one dock worker tests positive, and they test them almost every day, they will shut down the entire terminal. So it very well could happen again if the port of Shanghai or if the port of Ningbo or any of the major ports over there, if they were to crop up with another COVID case, we could see further shutdowns. There's also major restrictions coming out of China on air cargo. So these are looking at our transportation air cargo rates. These are price per kilogram in US dollars. Again, so just very stable throughout 2019. This would be what we consider a pretty normal rate, around $3 to $4, $5 per kilogram. 2020 hits, everything goes haywire. This is kind of the beginning rush of PPE coming into the country from China, masks, hand sanitizer, everything. They were able to charge significant rates then, but soon after, the vast majority of capacity for air cargo was taken offline. I'm not sure about the exact percentage, but a significant portion of air cargo was moved in the belly of passenger planes. I'm sure I'm explaining things that you already know, but a lot of that was taken offline. Passenger planes were pretty much grounded. We've seen a lot of capacity come back online. I think we're running at about 25% less capacity now than we were pre-pandemic. That's much better than it was this time last year, but still running with less capacity. But the big thing here is China is putting major restrictions on air cargo. They've canceled all overnight cargo flights out of China to Frankfurt, to North America, and to other major hubs that they have until the end of August, and it's likely that they're going to extend that again. Also, they have this very strict quarantine measure for pilots that land in China and must stay overnight. They have to stay for 2 weeks in quarantine. So it's actually pretty clever the way that the airlines have been building their schedules to either land in Seoul or Tokyo just after. They basically just land the plane in China, get everything off, and go over to Seoul before they do a cargo switch, so they don't have to sit in China for 2 weeks. But in any case, what China's doing is bringing the pilot capacity way down. When I saw a report that I think only a third of Chinese pilots are available right now because of their quarantine measures. So last time, so this, I was supposed to have a little animation on this, but I see it didn't translate to PDF. So last time I spoke about where are we in the freight cycle. This is one of the better charts that I've seen, and I'll try to explain it in detail here. This is from Echo Global Logistics. They're a pretty prominent third-party logistics provider in the US. So different phases of the market here in the blue line, you can think of this as supply and the green line as demand. You can also think of this as contract rates and spot rates. So in times where there's a soft market, such as 2019, it was a normal market, but it was also quite soft. Supply exceeds demand, which pushes downward pressure on spot rates, which eventually will translate into lower contract rates. But then when the market begins to turn, and you have this point now where demand begins growing faster than supply, that is what we've seen over the past 18 months, you have a point where supply exceeds demand. And last time I came in March, and at the end of May, rather, I said we were here. We haven't moved much. The demand in the US has stayed consistent, and there has not been very much supply added to this point. And it doesn't seem that there's going to be all that much supply added at this point. There's still a major bottlenecks at driver training schools in the US. They're running at about 50 or 60% capacity as pre-COVID. There's also this new alcohol clearinghouse that they put in the US, basically making it more difficult to, if you if you fail a drug test or fail an alcohol test, you're pulled off the market for an entire year. These things are taking drivers off the market. Something like 4,000 drivers a month are being taken off because of this. And then there's a big plan for an infrastructure bill in the US that's supposedly $3.5 trillion, going to create thousands or hundreds of thousands of jobs. This will also detract people from the driving market. So in the US, the jobs between drivers and construction are very flexible. People move between jobs depending on where the best pay is. And if we begin building everywhere and everything, it's going to be difficult to get drivers seated, even more so than it is now. So there's a chance that this driver shortage that we have right now is going to perpetuate for a long time. We're having a lot of difficulty attracting younger people into the market. Please stop me if you have any questions. I feel like I'm moving kind of fast. But here is here's some retail supply chain trends. So, and I'll add a couple as I go through, but during the May event, I spoke about transportation cost inflation. I will check that one off, definitely still here. And then these last couple I'll speak through in a couple more charts. So e-commerce acceleration, it is, obviously when people were locked at home, stores were closed last year, a lot of people began spending a lot more online. But we have seen that growth decelerate materially. It's still a much wider array of goods. People got much more comfortable buying couches and refrigerators, appliances, very big and bulky exercise equipment, that types of stuff, which is much more difficult to transport. You also have, faster and faster delivery times. So retailers are moving towards smaller fulfillment centers, smaller warehouses where they can position product closer to the end consumer outside of major metro hubs. You have your new fulfillment methods. Those are still very much working right now. We're a little bit behind the European markets when it comes to omni-channel and kind of just e-commerce in general. But retailers have over the past year begun leveraging their stores for way more fulfillment of online goods than they did prior. So they're fulfilling, the good ones, the Targets, Home Depot, they're fulfilling 50, 60, 70% of their online orders from their stores. That is much cheaper for them to do so. There's still a movement to direct to consumer. both brands and retailers. So brands are trying to cut ties with retailers. You look at Nike, Under Armour, Adidas, all of the biggest brands in the US, they are cutting ties with kind of what they consider undifferentiated retail and opening up their own stores, building out their own capacity to sell on their websites. And retailers are doing the same, but they are going more private label. So as these companies leave, they are opening up and launching a lot more private labels within their stores, white label stuff. And commodity price inflation, I will show you, it's definitely still here, but it seems to have peaked, at least the worst of it. So online spending, as I was saying, so we had this huge surge. Previous to COVID, the percentage of online spending out of total retail spending was between 12 and 13%. It surged to about a quarter of total spending in the peak of last year. And the peak of the onset of the pandemic. It surged again around Christmas time. Again, COVID was still very, very just ravaging communities in the US around Christmas time last year. So many did their shopping online. But since then, steady downtrend. We've yet to find a bottom of how much total spending will be done online. So commodity inflation is certainly visible in the US. I'd say there's two sectors where it is most visible. That is CPG and grocery stores. So food has gotten much more expensive in the US, something like 10 or 12% since the beginning of last year, since pre-COVID. And the major reason there is that the food supply chain, when COVID hit, let's just make it easy and say 50% of food went to grocery stores and 50% went to commercial uses. At that time, commercial uses basically went to 0 and grocery stores went to 100. Well, restaurants have exploded back since the economy reopened in between April, May, and June. And so basically we have this imbalance right now where food producers are having a difficulty matching demand for restaurants and for grocery stores. So we've seen it at restaurants and grocery stores, but it's most visible at the kind of building material, home improvement type stores. So Lowe's and Home Depot. I just listened to their earnings calls this morning. They spoke about price inflation ad nauseum. And here is a chart from an economist I follow on LinkedIn. He's very good. These are just price changes at building material and supply dealers. So you can really see the change here. And so one of the big discussions we've had at FreightWaves and just in the US economy is when will consumers begin to revert their spending back towards services? 70% of the US GDP is consumer spending. 2/3 of that normally is on services. So during the pandemic, that shifted towards about 60-40 services to goods. And that is what we've seen. That's what caused this huge boom in freight that is still going on today. So here's a chart from Bank of America. Sorry, it's a little blurry, but showing durable goods spending in dark blue, leisure spending, so services spending in light blue, and kind of everything else that fits in between in yellow. So you can see this is a 2-year change, by the way, comparing to 2019, because 2020 is just a difficult year to comp. But services spending, you can see to begin the year was way down 20%. But as soon as the economy reopened in March, it's been pretty steady upwards. But it has showed some moderation, as I think this is a little bit of Delta variant impacting spending here at services. But the big picture here is that durable goods has come down, but it's still really strong. We're looking at durable goods demand still up 25-30% over 2019. It's very, very good for freight. It's good for the economy. So inflation is real, but there is still a pent-up demand in the consumer side of the economy. So this is another chart from Jason Miller. Inflation adjusted retail sales. So the US does an awful job of presenting retail sales. And whenever they do, all of CNBC and Wall Street Journal, they'll all come out and say, oh, retail sales for the month of July down 1.1%. That was a very poor way of explaining it, because they adjust for seasonal changes, but they do not adjust for inflation. Inflation is quite high right now, so it needs to be adjusted for. And sometimes the seasonal adjustments need to be explained as well. But the big picture here is that demand is still really, really strong compared to last year, compared to any previous years. Goods demand is really strong in the US. And that's all I got. If you have any questions about a particular slide, just let me know. I can go up.
Thank you, Andrew. This is very informative.
Yeah, sorry,
And
it's a lot of data.
a lot of data, yes, and it confirms what I follow a little bit on the news. I just was concerned about also the fluctuation of the currency. Is that counted into this equation of the pricing?
Do you mean fluctuations between currencies, like between the euro and the dollar?
Exactly. Yes.
Yeah, we have some data sets that are denominated in euro, but none of what I've presented today kind of it doesn't include or adjust for any kind of currency fluctuations. And to be honest, I haven't looked at the Forex markets in a couple of years, so I honestly don't know how the dollar or euro has been performing as of late.
Yeah, the euro has been strong lately, the past quite a few months now. And I'm not sure if it has to do with the debt that the US is going with the stimulus and the projected budget, that I heard a couple of $1 trillion are being spent in infrastructure, are going to be spent. So I don't know how all of this is adjusted, but the euro is very strong compared to the dollar.
Yeah, there's this crazy stat I heard a couple weeks ago that 22% of all US dollars ever printed were printed in 2020.
So I had a question also earlier. I don't know if you saw that in the chat, but I could read it if you don't have access to the chat.
How do I get to the chat? You can just read it, Jean.
Yeah, so I actually have two questions. The first one is the one in the chat that says that you alluded to the time market in the logistic realm. So I was wondering whether, given that the demand is so high, whether there are any opportunities for disruption, and also because recently there was a lot of chatter around having driverless car. So I'm wondering what an opportunity now that there's a strong demand in logistics, and two, what are the opportunity for disruption? And then the other side of my question with that, with the number of people getting vaccination growing daily, do you anticipate that will relieve that pressure?
I'll start with the second question. The amount of, the vaccination rate is, it could help get people back into the driver's seat, but the truth is that a couple things. One, the U.S. driver pool is not exactly lining up to get the vaccination. And two, it's not this is something that autonomous trucks will help with for sure. It is not a desired job in the US, not because of the pay, because the pay has increased substantially since pre-pandemic, but there's unfortunately a really bad stigma around truck driving in the US. And we've got to do better as an industry of breaking down those stigmas. But I'm not sure the only thing that could help with vaccinations is, or just with COVID progressing, is further reopening of the economy, people feeling a little bit more comfortable, but get behind the wheel. I think schooling in the U.S. is a big portion of this too. Many drivers we've done surveys that have said, that drivers have told us the reason that they're staying off the road is because of their kids and their inability to get vaccinated, and them having to stay home and work with them from school. So that's one thing. I'm not sure how much the vaccinations are going to help get people back onto the road, but for disruption, absolutely. So the U.S. market is extremely fragmented, and autonomous trucks are probably the next big wave of innovation in our industry. And if you would have asked me a year ago when I thought they'd be here, I'd probably say closer to 2030. But over the past, there's been quite a much progress over the last year. So Too Simple, I'll call out a couple companies. Too Simple is one. They're a dual-based company in China and the US. Plus AI is another that's doing pretty remarkable things. And of course, Tesla will be there in the next few years as well. So I do believe that autonomous trucks will help a lot with the driver shortage. So what the companies that are trying to build autonomous freight networks are doing in the US right now is they are trying to get rid of the worst type of the drive. So the super long haul drive across country. They're trying to make that automated and just have a driver come and pick it up from the warehouse and drive it to the drop off point, have an autonomous truck take it to the next point. And what that does, it does great things for the driver role. It allows them to stay much closer to home, have a much more set schedule. They don't have to drive, for hours and hours and hours. So it's going to make driving a much more attractive job. That's first and foremost. And two, in the meantime, eventually it will cut jobs in driving. But in the meantime, it's actually going to increase the amount of workers in this industry, whether, because they need technicians to work on it, you need all these other people to help run it, but it's also, you're going to need way more local drivers to connect to the hub and spoke model of autonomous trucks. I hope that answered your question.
Yeah, thank you. I'm sure, we spoke more about the truck driving, but I was wondering whether with all the airline with plane parked in the desert, is there like a shortage of pilot that they could repurpose those planes for cargo? I don't know if that's something also that's being contemplated, or it would be cost prohibitive to do that.
There has been some transitioning of passenger planes over to freighters. I'm not exactly sure. I don't have any percentage or data for you, but it has happened, certainly in the US and in China as well.
Great. I think there are more questions on the chat.
Okay. I don't know how to get. Oh, here we go. It's up here. Oh, there it is. Okay.
Mm-hmm.
How do you calculate inflation regarding supply excess, and where do you gather data to draw supply and demand curve? I'm thinking you're speaking of this chart, most likely. I think, Joseph, where do you get data?
Close to euro, no.
Were you speaking of this chart for supply and demand?
You're right.
Yeah, this is more just kind of theoretical, just a model. But the data that we would use to, if we were to build our own, would be this data right here. So for demand, this would be our demand curve. We could use growth, the growth of this delta of our demand curve, and then we use this. Oh, whoops, sorry. I'm sorry. I'm very sorry. We would use this as our demand curve, the Outbound tender volume index, the growth of this, and we could use change in this as our supply. The Outbound tender reject index. So this is a measure of relative capacity in the market. It's a measure of carriers' willingness to accept loads, which can be, inferred as a proxy for capacity for supply. And then your first question: how do you calculate the inflation regarding supply excess? Can you add some color on that, Joseph? What do you mean by that first question?
Yeah, because in the past we never had a COVID impact in the economics. And I have no idea if there are some statistics from 1918, the disease in Spain.
Mm-hmm.
And therefore I was wondering, the supply and demand excess is really a lot. And I was wondering how you got this data, how you gathered the data to, it is running somehow on the quotation parallel, whereas supply is hanging above in larger proportion. I was just interested to know, how you calculate this graph.
Yes. So yeah, as I said, this is a kind of just a model, a theoretical look at supply and demand. It's not backed by any data. It's just this. The U.S. I would assume it's the same way in Europe. The U.S. is a very, very cyclical market. Trucking is. So when rates are high, truck drivers flood into the market to take advantage of those rates and very quickly crash the market. But we're not seeing that right now. We're not seeing people come into the market at the same rate that we would have, that we would, let's say at the last kind of boom cycle that we had into 2017, 2018, the Chinese tariffs and generally strong demand kind of pulled forward a lot of freight demand and flew trucking rates up. And that brought about 4 or 5% capacity into the market, and that was enough. 4 or 5% tanked rates. Rates were down 30% in about 6 months. It's very, very cyclical, and people in this industry have no capex discipline. So when times are good, they start spending, but they just haven't been spending at the same rate now, and demand has not slowed down at all. So we're still in this case of supply exceeding demand, or demand exceeding supply, rather. Sorry.
Yeah, my background is in economics, and I have taught corporate finance. There is an equation from Professor Fisher, international inflation, and that would be interesting to know, how you associate this equation in the supply, demand, and then certainly the inflation, especially regarding the US dollar and euro. If there is such a consideration, or it is not really so important to discuss about or mention the graphs.
Yeah, unfortunately, I just don't. I don't really have an answer for you. I'm sorry. It's not really. I don't believe it's thought about in this chart in particular.
Yeah, no problem at all. Just I was wondering if there is a consideration regarding the equation of Professor Fisher. I can send you per you email the international inflation.
Yeah, I would love that. My email is at the bottom. I'll scroll down here in a moment.
Yeah, I am going to write it down. Please scroll down the slideshow, please. Thank you.
I have a question here from Hubert. I do not have any idea on the proportion of US and Europe. I would assume much less. First off, the percentage of US pilots that are vaccinated is much higher than the rest of the country. I think I'd read 80%. And second, we don't have these, like China has a strict quarantine rule of anybody that comes into the country and stays overnight. I assume that in the US, they would either just check vaccination or do a test. And if it was negative, you would not have to do any such quarantine. So it's not really, the US doesn't have these quarantine laws that are keeping people off the ground, or out of the air rather. For truck drivers, there's definitely a portion that are staying off due to COVID. We don't know exactly, but overall, we know that the amount of truck drivers driving is back to where it was pre-COVID, but demand is up about 15 to 20%.
It's surprising that they have waited for COVID to implement hubs, because I had been working 10 years ago for a French leader in freight, and I urged them to implement daily hubs for truck drivers that would say that say can go and come back on the same day and back to say family, and net the whole Europe. But the problem at this time is that the drivers were hunting for bonuses and primes that they could get when they work long time or on long trips.
Yeah.
Right. And nobody did the work during the last 20 years. So I'm totally surprised that now finally it arouses some are trying to implement this, but it can only be a global national decision. I don't know how to manage this, because the same in Europe. The only people interested in driving trucks are Polish or people from Eastern Europe that we, for the time being, can manage. And the tension is very high also on this line. So I'm still wondering if somebody is doing something somewhere. that's a totally off subject question, but I hope somebody will implement this quickly.
There's a company that is kind of making some waves in the US. They're a very, very young company. I think they're only about 2 years old, but it's called Baton. And they are, Baton, Baton, like the relay baton. And they are creating kind of relay convoys that are very clever. So they've basically got this big trucking yard outside of Los Angeles, and they're putting another one outside of Atlanta. So major freight hubs. And what they are doing is it's a simple process called just drop and hook. So rather than taking it from one place to the other, you take it to a hub, drop it, allow another person to pick it up and go. So creating these hubs, and they are growing really fast. They've won a couple of awards for innovation in the last couple of years. So there's people working on it. But I agree. There's a saying in English, in American English, if it ain't broke, don't fix it. And it's kind of one of those things where the U.S. trucking industry has just gotten along as it is, and it's been very, it's been a very old school, old white male dominated industry, and that is beginning to change as well. But they've just been stuck in their ways. This industry has been very, very slow to adopt new technologies, very slow to adopt new processes. But that is very rapidly changing. Thank goodness.
I'm happy to know that somebody is beginning to do the job, because in Europe, last 2 years ago, I've been working for Freightos, which is also a leader in this area. And when I mentioned the subject, I'm just a finance director, so I'm not a marketing guy, but everybody lost at me. So I'm happy to know that somebody is working somewhere on the subject, because it's not satisfying to drive trucks. It's no more satisfying to drive trucks across the world on long distances.
Right.
Okay. But well, so, and when do you imagine a restabilization of the offer demand market? Because it seems very high, and it seems very high for a long time, according to your graphs. I don't see what will bring them back to normal prices and offer.
So what will bring demand back down to normal, or to, I think demand will be elevated from a historical standpoint. At least, I mean, it could be, we could be at a new normal of goods demand in the US. But the one thing that will change that is the rest of the world getting vaccinated and allowing Americans to get out of America and go spend money elsewhere. A lot of the additional money being spent on goods now is coming from a reduced spend on travel. So, lodging spending in the US, so spending on hotels and spending at restaurants, it's already back above pre-COVID levels, back above 2019 levels, but spending on airlines is still down about 33%. So when other countries get vaccinated and the kind of the world economy begins to reopen, I think you'll see a stabilization of demand at that point. Hopefully before then we can get some supply into the market. This is going to be a very difficult thing to balance, because demand likely will fall off pretty quickly. I have one more note to make on demand, but demand will likely taper off fairly quickly, and supply will definitely come up pretty quickly. So it's going to be a thing to balance coming out of this. One thing that will keep demand elevated even longer than consumer demand. So consumer demand will fall off, but likely freight demand will keep going a little bit further than that, because inventories in the US are really, really low across every sector pretty much. You're starting to see the biggest companies, Target and Walmart, they're finally getting an opportunity to build inventories. So both of those companies grew inventories faster than sales for the first time since the beginning of 2020 in Q2. So that's a positive development. But it's going to take a while to build back inventory. So even when consumer demand falls, there's still going to be a lot more freight to replenish those inventories.
Okay, clear. Understood. Okay.
Any question, John, from regulation? There certainly are opportunities for regulation to help this pressure, but the trucking industry is quite libertarian. They like very little government involvement whenever they can get it. So I think the opportunities for regulation is in this industry, speaking more broadly, are on emissions and sustainability. I think that's where you'll see more regulations coming in the next few years, rather than on some sort of price or or anything like that. I'm not sure that there's going to be much to help there.
I mean, I was wondering because I think it was 60 Minutes that was talking about particularly a truck driver, the pressure they have to move freight, and they don't have enough time to rest, which is a danger on the road. But they also stress that most of the truckers are owners, meaning that they are like an independent contractor, and they don't really see a future. So being that with the advent of driverless car, a lot of people are not so intent of going into that business. So I'm wondering how, until we get those driverless trucks on the road, and we are seriously losing driver. I'm wondering what's in the intervening period. What is it I'm going to do to really sustain the model? Because it seems to me that from what you share so far, I feel like it seems to me that there are opportunity or inefficiency in the system that have yet to be resolved.
Yeah, there are major inefficiencies. It's a highly fragmented market. There's one thing that I think is inevitable when autonomous trucking becomes readily available. I think we're going to see major consolidation in this industry. There will be players, there will be autonomous players that go for that bottom market, that are selling some sort of subscription service to the technology. But I just have to believe that, especially in the early days, just look to the warehousing industry and look at robotics there. Who were the first to implement it in a major way? It's Amazon, it's Target, it's Walmart, it's the companies with the biggest balance sheet. So I have to think the same thing is going to happen with autonomous trucks. I haven't put much thought into what happens to the little guys when they get here, other than I think they're probably going to get gobbled up pretty quickly. Oh, and I did wanted to mention another thing about a difficulty with the drivers. Another thing that restricts their hours that they can drive is, I think on average, they're spending over an hour per day just looking for parking. There's about 4 truck drivers for every 1 parking spot in the US. So every 1 truck parking spot. And it's illegal to park on the side of most highways. The one spaces that it is legal, you'll see truck after truck after truck after truck, but there's very few parking spots. So drivers are taking the last hour that they have available to drive. They can drive for 10 hours. They're usually not even driving for that last hour because they're trying to find parking. It's a big problem. That's actually, I think there's about $10 billion in that infrastructure bill, and the proposed infrastructure bill that is going to be spent on truck parking. So the trucking industry is very happy for that.
I traveled this last weeks across Europe, from Northern Europe to Italy, and I noticed that on all highways in Europe you have many parking areas for trucks, which seems not to be the case in the States, and nobody cared in the States during the last 20 years or 40 years. I don't know.
Yeah, like I said about that stigma with truck drivers, they're also kind of just a forgotten breed of American workers, and they don't get, although there are millions on lobbying dollars spent every year, they don't get a lot of say in Washington. Oftentimes when new regulations are brought into the market, you often see this in the state of California. They'll implement new regulations on contractor workers or on emissions, and they'll do so without even consulting the industry. And that happens all the time. There's been this huge fight with a contracting rule. Basically, the state of California was trying to limit the ability to use contractors, and they didn't even talk to the trucking industry. And the trucking industry eventually filed an appeal and won But it cost them, I think it was like a $50 million battle for the trucking industry in California to get this passed. So yes, they are forgotten in legislation and forgotten in building, forgotten everywhere, unfortunately.
Okay. Well, somebody is taking the margin somewhere. No.
And Andrew, how do you see the future, short-term future regarding all those?
The short-term future on parking or on truck driving, on what?
No, the whole supply chain and COVID.
So my short-term thoughts are, we have supply growing, either pretty much everywhere you look. Supply is growing on the ground with trucks. Supply is growing in the air with more cargo space. It's growing, well, not very fast on the ocean. We've pretty much got every ship available chartered right now, but it's not growing as fast as demand is growing, so it's not making an impact yet. But demand will slow. So we still have major congestion. The ports of the U.S. are, it's getting to a really bad point. So the port of LA Long Beach, our biggest port in the U.S., it has been consistently congested with 15 or 20 boats sitting in the bay awaiting berth since about August of last year. That number has grown to about 40 boats right now. And now there's about a dozen boats waiting outside the Savannah port in Georgia, one of the major East Coast ports. And for the first time this year, there's boats lining up in the port of New York and New Jersey. So that there hasn't been congestion there, but there is now. So the demand is unabating in the US and supply is trying to keep up, but there are major congestion and bottlenecks everywhere. And that's once it's produced. Now we have, COVID, we have the Delta variant, just doing terrible things in Southeast Asia and many of the apparel manufacturing hubs and many of the just consumer goods manufacturing hubs in Vietnam and Malaysia and countries like that. So it's going to be a very, very rocky road forward, but demand is staying really high. That's the good thing for the American economy, and the good thing for the shipping industry too. People keep moving the goalpost, as they say, with their expectations for how long this will go on and when it will get better. Thinking back to 2020, everybody said, oh, we just need to get the Chinese New Year 2021 and the ocean congestion will abate. Well, that didn't happen. Then they said midsummer. Of course, that hasn't happened. Now they're saying end of year. That won't happen either. It'll be sometime into 2022, possibly end of 2022, before we get any real stabilization on the oceans. And the trucking is likely the same.
Mm-hmm. Clear.
Possibly very hard to get back to normal, right?
Yes, it's going to be difficult to get back to normal. From the ocean side, I'll say that I don't think we'll ever go back to what they were paying pre-COVID. I think these ocean carriers have made two decades worth of profits in 1 year, and they're going to be very reluctant to give that back. So I think they are going to be very disciplined with their CapEx. I don't think you're going to see a lot of ocean capacity grown. And, to think these ships take 3 years to build. So if they ordered them last year, it's still going to take a while for them to get online. And then on the trucking, we've had big orders of new trucks. We saw record orders of new trucks, but the ones that are actually being delivered are not that many. The truck building companies in the US, again, they're dealing with the same supply chain challenges all of their customers are. They're having raw material shortages of iron and all the metals that they need. Their costs are going way up. They're having difficulty sourcing labor. So it's difficult to build trucks. And then once you even have a truck, it's again really difficult to seat it. We're having a difficult time getting drivers into the market. So it's one thing after another. It seems that we take 2 steps forward, 1 step back every week.
So
Did a new deal.
So I know we spoke a lot about trucks and cargo carriers. So how about rail? Has rail freight changed significantly in the US in response to COVID or the tightening in the market?
Let me see if I can pull something up really quickly.
I can give you a clue what happens in Europe, because I was CFO for the major rail builder in Europe. All the companies have renewed say fastly say rails during this period. So the tracks are ready to be railed. But we had problem getting iron. Voilà, with logistics and freight coming from India or other countries. But I don't see USA building more rail lines.
No, unfortunately, no, that not part of the infrastructure bill.
No.
It's changing. There is a new budget that was approved for infrastructure, and the high-speed rail is going to pick up again.
Hey, wow.
Announced, yeah, it was announced, and especially between Boston and Washington, D.C., which is going to impact the airline industry and the auto industry, because people are, for a short travel, they will rather take the high-speed rail and end up from a large city to another large city rather than finding themselves outside of a big city by the airport. So this is, I work in the transportation industry, construction, and that is the new motto, or the news that we just found out.
Well, that is very exciting. I'm a big fan of trains, and I wish we had more of them in the U.S. So Amtrak, if you've heard of that company, it's the slowest train in the world. They're expanding, or they've proposed new routes here in the South. So I live in the Southeast in Tennessee, in the U.S., and we have no rail connections in the city that I live, or really in any of the surrounding regions. But they've just proposed some new ones, but they're very, very slow. So they're oftentimes take 1.5 times the drive time to get there. So, for example, they're proposing a line from Nashville, Tennessee, my hometown, to Atlanta, Georgia, which is kind of the next major city down. And it's about a 4.5 hour drive, and the train will take 6.5 hours. Mm-hmm. So
that's going to change.
Depending on the cost, the price of it, I'm not sure how many are going to jump on that.
Well, it's hinges also on the how many towns will be serviced, because it's not like going straight from Tennessee to Atlanta. I'm sure they would like to win one down some town as well.
Yeah, there's a couple stops. So they're going to stop in my town, in Chattanooga. My town's basically a midway point between Chattanooga,
Nashville, and
Atlanta. Mm-hmm. Yeah, so they will stop here. I think there's going to be 3 stops, one in kind of a northern town in Georgia, one in Nashville, or one in Chattanooga rather, and then the other in Nashville. There's not much between Chattanooga and Nashville.
I heard that Nashville is booming. The headquarters of the major investment company that I worked at, the headquarters moved from New York City on 6th Avenue to Nashville. And that was 2 years ago. And everything is changing. The hospitals, the transportation, schools, everything is affected.
Yeah, Nashville is blowing up. So I grew up there, and the joke I like to tell is that Nashville was a great place to grow up. It was a great town to live in. And then somebody came and they left and they told everybody. And it is, it's still a good place to live, but truthfully, the public schools in Nashville are really, really bad. The public schools in Tennessee in general, they're one of the worst in the country. And the public transportation is non-existent. There's no rail in Nashville. The bus system is very poor. And they have extended the interstate in Nashville and made it a little bit bigger over the last couple of years, but traffic remains very, very bad in Nashville too. Here, I'm going to show, can you guys see this? Are you seeing that? No. Hold on. I think I need to do this. One moment.
But it's the best place for the music industry.
Yeah, it's the best place for the country music industry, and it's expanding for sure outside of country. So here is some more sonar data. So guys, this is what sonar looks like, by the way. So what you're looking at here in blue is the total inbound rail volume in the U.S. It's down considerably actually from 2019, and but it's up a lot since the bottom in 2020, but still below 2019. And to be honest, if I were to guess, I would truly be guessing here. So I can, if you guys want some more rail data, I can send you guys some stuff. We have a rail expert that writes on rail all the time. So if you want some more stuff, I can help you.
Just a question: what are your major customers? Who pays your data for your data?
So the major trucking companies in the U.S. are some. So you think of Knight Swift, Werner, Schneider National. These are really big trucking companies with 20,000 trucks or so. But we've also got big retailers, Wayfair. I'm not sure if Walmart or Target is a customer, but there's a few e-commerce retailers. We're growing into shippers. We really started out with truckload companies and brokerages. We're really big in the brokerages. I want to say we've got 10 or 12 of the top 50 as customers. So brokerages and carriers are the big ones now, but we're expanding into shippers and expanding into financials as well. There's a lot of financial institutions that are using it to trade the stocks of the transportation companies.
Okay.
And then so here in orange this is not rail, but this is intermodal cost. It's kind of just a more applicable to trucking. So intermodal, and if you're unfamiliar with it, it's just they take the container right off of the ship. They put it right onto a rail chassis, and usually like the major route is from LA to either Dallas or LA to Chicago. So they'll take them right off the plane, right off the boat rather, put them on a rail, take them on a rail all the way to Chicago, where they will then be put on a truck. That rail will just go right on, the box will go right onto a truck, and then that truck will take it to its final destination, where it's either transloaded into another truck or it's there at the warehouse. That's so intermodal. So this is intermodal rates flew up in the back half of last year, but have come down since then.
Okay.
How do you spell sonar, Andrew?
SONAR.
Yeah, and that's the name of the software?
Yeah, so it's up here. So FreightWaves is the name of the company, and
Right.
Sonar is the.
Oh, sonar, that's over there, right? I'm sorry.
So while I'm here, I mean, I might as well show it off a little bit. There's some very cool ways to look at data here.
Ah oui.
So, so here, of course, the map of the U.S. So the height of each market is how big it is. So it's its market share. So this is the Atlanta market. It's a very, very big freight hub. It's also a huge city, the biggest city in the Southeast. And then so out here, out west, you have your biggest markets. So the LA is here, and Ontario, California, they call that the Inland Empire. If you ever fly into LA, you'll see that there is a whole county that is nothing but warehouses, and that is what is here in Ontario. Inland Empire. It's the biggest market in the country. Atlanta is up there. It's in the top 5. And then you up here in the Harrisburg, Pennsylvania market. So it's big, feeding Pittsburgh, feeding even into New York. That's a big hub as well.
That's where the company you mentioned before has planned, comment il s'appelle, has planned to Baton has planned to put its hubs, huh? Chicago, Dallas, Atlanta.
Yeah, Baton. So Baton's hubs, they've got one in Ontario, and they're building another in, I want to say it's North Atlanta. And then I'm not sure where they have them planned, but I would assume that they'll eventually have one probably outside of the Dallas market as well. And Chicago.
Dallas, Atlanta, Chicago, Los Angeles.
What's that?
I went on the site and they mentioned Dallas, Atlanta, Chicago.
Oh, okay. Yeah.
On top of Los Angeles.
Yeah, Chicago. That would make sense too. That would be my guess. So yeah, Dallas, Atlanta, Chicago. I guess they haven't started on the one. I just figured they had one out west because that's where they're based in San Francisco. Okay, and then so the colors here. Actually, I'll show you a different data set. This is very cool. So this is one of our newest data sets that we have created. So we wanted to, people want to be spoon-fed, and we tell them, this is the demand out of this market, this is the supply out of this market, and you can compare it to other markets. Well, that was, they wanted something to get it as close to apples comparison as we could get it. So this is our new capacity trend market score. So it's on a scale of 1 to 100 or 0 to 100. 100 would mean all of the power in the negotiations on spot prices are for the carrier. So that is a very dominant place. Basically, carriers can pick their price. And if it were 0, the opposite is true. Shippers can pick their price. A 50 would be somewhat of a balanced market. So this colors range. So the darker the color, the darker the score right now. So the more power carriers have. You can see the biggest markets, Ontario and LA, very, very dark. Carriers are in a very good position out here. But some of the Midwestern states, again, remember that the height depicts how big the market is. So you think here, oh, shippers that are in this area, they can get good rates. Well, there are very few shippers in this area. We're talking about the deserts of northern Texas and New Mexico. And same goes up here. So you can get, yes, of course, you can get better rates and you can have better negotiations in North and South Dakota than you could in Atlanta, so to say. So that's that. So you have capacity a bit tighter in the South right now. Part of that is due to the tropical storms that are going on in the South. And honestly, this right here is outside of the Chicago market. So Chicago's here. This is where the intermodal hubs are, the rail hubs that come into Chicago. They come across the country into these markets. And over the past several weeks, the major rail lines, BNSF and Union Pacific, the ones that run these lanes, they have been metering and at some points even stopping rail from the West Coast because they had so much stuff, so many boxes piled up in Chicago that they said, okay, we're cutting off this lane for 2 weeks while we clear this up. And it still isn't cleared up. There's still a lot of freight just piled up right there. But yeah, here's the maps. There's lots of other things I could show you, but I won't belabor you with it. I love this map. It's a very cool feature.
Yeah.
I have a suggestion to Congress if they let me come in. And now is a good time to build a railway for supply chain and creating millions and millions job in the time that there are many unemployment.
Yes, I couldn't agree with you more. I think if I had to guess, I really think that the U.S. is just kind of wanting to leapfrog. You know how Western countries and developed countries will tell developing countries that you can skip over combustion engine cars. You guys need to go straight to green cars. You need to leapfrog this technology. I think the U.S. is waiting for a leapfrog opportunity over high-speed rail. And I don't know if you guys have kept up at all with Elon Musk's boring company. They've increased the ability to bore tunnels underground, brought the cost down by about 10x, and have increased the speed about 3 or 4x. So they're getting better and better. I think they are waiting on that company and others with the Hyperloop. I don't know if you guys are familiar with that at all. That's the next form of transportation. And I really think the US is just kind of waiting on that because it would take 10, 15 years for us to build a rail. And in 10, 15 years, the Hyperloop will likely be ready for implementation. So if I had to guess, that would be my guess.
I mean, I think Elon Musk has been doing something between Baltimore and DC for a while now. So we are waiting, when it's gonna actually get in service.
Yeah, so they finished their first kind of completed project in Las Vegas. It's a very short track. It's only about 2 miles underground in Las Vegas. And right now they're literally just Teslas with drivers in them running back and forth through these tunnels. Within the next couple of years, you'll be able to take the driver out of that Tesla, and it acts as an electric passenger trolley. But the thing is that the tunnel that they built is plenty big enough to put a Hyperloop through it. So if they can build that rail under other cities at a much longer range, you can eventually put freight through that. You can put passengers through it. But yes, I'm a big Elon Musk fan. If you guys, well, it'll be long past your bedtime, but Tesla is doing an AI day today where they're going to kind of open up the doors to a lot of their artificial intelligence technology. It's going to be really awesome. So look out for stories on that. It'll be interesting.
If there are no more questions, it's already 1:40 in New York and I would have to leave shortly. I have a meeting coming up, but thank you, Andrew, for the very interesting and informative presentation. It really is bringing economics and markets up to light today in light of the COVID and all the issues you presented. So we thank you. Yes, if you can send me anything you have, data on rail, that's my industry. You have my email address. I will send it to you. I'll put it in the chat box. Yeah, anything you have, because it's changing as we speak, and the government has approved a huge part of the budget to move it forward. We were number 1, and we're now number 26 in the world in high-speed rail, so we have to do something. If you have any questions for us, or any, if you need, you can also, as we mentioned earlier, you can click on the chat. There are 3 buttons on the bottom right-hand side, and you can save the chat. And this way you get a rundown of who was in, what time, their email address, if they presented it. And so that's quite helpful. Look it up in your computer. It should be in one of the drives. Usually your main document, where your documents are saved, or your uploads. Hubert, you have any points that you want us to bring out before we close the meeting?
No, nothing. Just thank you to Andrew for his presentation, and very interesting software, fast software, data analysis. Looking for the same. We have the same kind of thing for Europe, but this one seems to be nice.
Well, thank you. I appreciate the opportunity. In the chat, Vivian, I went ahead and put the rail expert for FreightWaves. If you just Google him, all of his stuff will come up from FreightWaves.com. But I'll see if there's any kind of paid research that he's done that I can snag for you of recent. And then I also put in just my LinkedIn there. So if anybody wants to add me on LinkedIn, I don't know if you guys are on LinkedIn, but please add me.